The tariff war is causing massive volatility in the equities and bond markets. What's that mean for mortgage rates? Welcome to Dre's Take. Last week, Trump announced his reciprocal tariff plan across the board, sending investors scrambling for safer assets. Typically, when this happens, investors see U.S. bonds as the safer alternative to park their cash until things settle down. At the end of last week, that logic seemed to hold true. As the stock market sold off, we seen investors flock to the bonds, and subsequently yields came crashing down, taking the mortgage rates along with it. This was sort of a silver lining for would-be buyers amidst a much bleaker economic backdrop. Today, however, Wednesday, April 9th, Trump announced that he would be pausing the tariffs for 90 days, or most of the tariffs at least, while escalating the tariffs on China.
I love this guy, whoever the hell that is.
In retaliation for their retaliation. As the back and forth continues, investors are finding it difficult to find stable ground. Upon today's announcement, the stock market rallied while bonds sold off. However, the bond sell-off seems to be outpacing the capital returning to the equities or stock market, suggesting there may be a deeper problem here, an erosion of confidence in America's debt instruments. Perhaps large debt holders such as China itself or other foreign nations are piling on to offload these bonds. Or perhaps large institutional investors are offloading the bonds and choosing to hold on to cash until the dust settles. Either way, it's wreaking havoc on the bond market, even while stocks recover some of last week's losses. What this means for mortgage rates is the inevitable spike back up towards 7%. And even scarier is that if the pace of this bond sell-off continues, mortgage rates could skyrocket to levels that would be devastating to the real estate market and broader economy, causing some economists to call upon the Federal Reserve to step in and start purchasing these bonds in order to stabilize the market. That, along with calls to lower its benchmark rate in order to make it easier for businesses to continue borrowing through this current economic turmoil, may be necessary to curb a wider economic downturn or even, dare I say it, recession, which most economists are now saying is a coin toss, 50-60% likely. But what do you think? Is this unpredictability part of Trump's negotiation strategy? How long will it take for him to get the leverage that he's seeking? And will it all be worth it when it's said and done?
That's why I say be cool. They were saying about, just be cool, it's going to work out.
Let me know your thoughts in the comments. In the meantime, if there's anything I can help you with your real estate goals, feel free to reach out. I'm always happy to help. And until next week, that's Dre's Take. All right, y'all. Take care.